Wondering how your pay works as a director? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And probably the most common question with new limited company owners is, how do I pay myself? And actually that could well have been the title for this video, but I wanted to talk to you in brief about kind of the options you have as a director to pay yourself, because actually when you narrow it down, there's only a kind of 2-3 options that you really want to be talking about, although they are wide and varied. So before we get into this, if you like these type of videos, make sure to click the subscribe button below so you're notified whenever we release more just like it. So let's talk about the 3 options. So option 1 is you could just do what you've always done. So let's say you've been an employee for years, you get your pay slip every month, your tax and national insurance gets deducted, you get the rest. It's all done, paid for, no real complication, unless you've got company cars and some of these other things that tend to complicate it, but generally it's very straightforward. Now that is really, I suppose, if the revenue probably could make, and I'm putting words in their mouth now, but if they could have it their way, they would probably have you do this, because for them it's the biggest tax take. It's probably the worst of the tax positions that are possible. So that would be the easiest way. It's also for you, it would be straightforward, because you'd have your pay slip, you'd have your P60 each year, tells you how much you've earned. You know, when you're going for lending and mortgages or anything else, it's very straightforward. And that is some of the pros of doing that way. You also get to knock your whole of your wages from your limited company off of your tax bill. So before, if you imagine your profits, you get to deduct your wages, whatever you've put through your payroll, and then you're taxed on the rest. So if literally you took all your money out in wages and put it all through payroll, you'd potentially have no tax. Now that sounds amazing, but in reality, it actually isn't. And of course, the downsides to this is that you're going to pay more tax. And the reason being is that you're going to pay national insurance on that at 12%. Depending how much you're taking out. So let's say you took out more than about £737 a month, roughly. And you're also going to pay some national insurance. You're going to pay 2 national insurances depending on the level. One's at 12% and one's at 13.8% as you as the company. So you'll pay some. But what you might not have noticed when you're employed is your employer was also paying national insurance into the pot. And now you are your employer, it's quite harsh, because you end up going to almost pay 2 lots of national insurance, or it feels like you're paying 2 lots of national insurance. So as we talk about the options, people don't tend to do this particular option. Where you tend to see it is if the company's making a loss for a sustained period or something like that, but that's probably outside the scope of this video. So there are some pros to it, but there are also some cons. One of the other cons is you've got to operate a payroll scheme. So in order for this to be kind of legitimate, get that tax deduction, get that document and those pay slips and everything else, you're going to need some sort of payroll software. You register for the revenue for an employer's payroll scheme, or a PAYE scheme as it's often known. And every month, on or before that payday, you're going to go and submit a report to the revenue. As always, if you don't submit, there are fines. And also it lacks a bit of flexibility, because if you like to pay yourself, you know, every week, but you can't be bothered to do the paperwork until the end of the month, in theory, you're kind of breaking the rules, because you need to have submitted that rule on or before the payday. So it can be a little bit inflexible as well. On a positive note though, one of the benefits of running that payroll scheme and paying yourself hopefully more than say £6,300, and I'm going to use rough figures here, in a tax year, you're going to get a sort of a tick in the box that says, right, for your state pension, you have what they call qualifying years. So it just means when you get so many of those years, they eventually say, great, you've qualified enough where you can now have a full state pension, and you need to get so many of those years. Now, if you're paying yourself under that, you might not get those qualifying years. Of course, on this, if you're paying it all through payroll, you're going to be fine generally, and that's going to be completely fine as well. So it's one of the pros of doing it. So as you can see, you've really got tax deductions, the fact that it's relatively simple to understand. There's not other tax bills you've got to worry about. You can just manage it all inside the company, and they're really, really good things. But on the downside, you do have a bit of a lack of flexibility, and it's going to cost you more money. Basically, it's going to be tax inefficient, as it's known, because of all the other things that you could do as an alternate. So then you tend to go the other way. People will then say, well, I'm not doing any payroll, because, you know, whilst not paying any corporation tax sounds like a good idea, you're going to end up paying, if you imagine at the time recording this video, for a lot of people, their corporation tax bill is 19%. And their personal tax bill is 20%. So by you putting the payroll through, you're choosing to pay 20% rather than 19%. You're also choosing to pay national insurance in probably 2 places. So that can be quite horrendous. The alternative is you could take some of the profits out in dividend. Now, there's other videos that we've recorded on the channel about dividends, and you can look those up to make sure and understand what they're all about. But in reality, all it is it's profits. If you're generally a small business owner, you've got your own limited company, you will own some of the shares, therefore you're normally entitled to take some of the profits out in what's called dividend. Now, if you do that, that doesn't go through the payroll. So actually, in a weird way, the paperwork's easier. You still need some paperwork to make sure it's legal. You need some sort of meeting minutes, and quite often people tend to do vouchers, they call it, as kind of confirmation, written confirmation that the dividends were legal. You kind of need to prove that there was some profits there. So there is a little bit of paperwork, but there's no fines associated with this. It's not like you've got to click a button every single time that you do it every month or every week or whenever you pay yourself. So from that point of view, dividends are a little bit easier to do. Now, that's good. They've also got lower tax rates associated with them. So although you'll pay the corporation tax in the company, you're also going to get out some dividends. Now, if you take, let's say your whole income's under £50,000-ish a year, your dividends are only going to have about a 7.5% tax bill. So that's quite good, it's quite cheap. But you've kind of got two bills going on here now. You've got personal tax bill for those dividends you're drawing, and you've got the company tax bill at this, say, 19%. So there's a couple of things to manage. It means you need a personal tax return here as well. So there's another piece of paperwork in. But the main thing is those dividends don't have national insurance attached to them. So you're not going to pay that kind of double national insurance. You're also not going to be paying 12 or 13.8% in national insurance. These dividends are only about 7.5%. On sort of comparable amounts. So as you can see, that does save quite a big chunk of money. The problem is, as we already mentioned, if you don't have any payroll, and again, that kind of sweet spot is around 6,300 quid a year, so you won't get the state pension qualifying year you need. So you're actually capping yourself with potentially your pension in the long run. So that's a big deal. And also, you're missing out on some corporation tax deduction because your money that you're drawing in dividends doesn't get to come off your profit. In fact, it is your profit, so there's no kind of deduction for it. And therefore, what tends to happen, option 3, which is where most directors sit, is you end up with kind of a best of both worlds. It's kind of a balance between the two. You have a small salary, and this really depends on your situation. So I'm talking generically here, so don't go immediately saying, I saw that dude on YouTube and he told me it was this value was the best, because we could probably do another video on the best salary and talk to you about what that looks like generally. But let's just say you didn't have any other income and you wanted to split it. You might have a salary of around £735 a month. And that gets you your state pension tick in that record. It gets you about a £1,600 tax deduction, so that's great. Gives you some earnings on paper as well on a P60, like a slip at the end of the year that says how much you've earned. And then the rest of it's going to come out in dividends. Now, the combination of all the different taxes saved there is probably the sweet spot, and that's where you'll see most people doing it. Small salary, high dividends. Obviously, there's a lot of paperwork to do that in both cases. So to get that best tax result, you've kind of got the paperwork issue for both. You need to run the payroll scheme. You need to make sure you've got the right dividend paperwork, but you will save vast amounts of tax in doing it that way. I say tax, but tax and national insurance in reality. And you've also got to make sure that you plan. And again, there's plenty of other videos we've done on this, but you will have, the company will have a tax bill, and you yourself, based on how much money you've drawn from the company, are likely to have a tax bill as well. And it's marrying those two things. The beautiful thing about the split as well is that quite often it gives you maximum flexibility. So what you'll generally do is all money you're drawing from the company will sit in what they call a director's loan account. So it's almost like at that moment you've kind of drawn it and you owe it back to the company. And then at the end of the month, normally if you've got an accountant or somebody helping with you, they'll go in and make sure that some of that's declared in salary and the paperwork for the dividends done, or if you're doing it yourself, you're going to need to make sure those kind of things balance out that pot of money that you've borrowed during the month. But it does allow maximum flexibility. So that's kind of it. So to recap those, because I know there's a ton of information in there, it's not a very straightforward thing. You kind of got 3 options. Pay yourself all salary through payroll like you would if you're an employed job, but that's not going to be a great tax result. You can pay yourself fully in dividends. You may do this, some people will do this if they've already got another job. That's quite a common thing. If they've got another job, they will quite often do that. That's okay, but you've just got to bear in mind, could you have used some salary to get your state pension record and a tax deduction? But more often than not, if this is like your full-time deal, you'll find that you'll do a split of both of those. You'll have some salary, very low level, and then you have the rest in dividends. So that's giving you a bit of an idea of the type of things you could do to pay yourself some salary. And I'm sure if there isn't already, there'll be more videos on the channel talking about how to kind of give you some pointers of how you might determine it, because it really is dependent on your exact situation and your goals with all of this kind of stuff. So hopefully that's a help. If you know somebody that needs to know this information, please do share it with them, and we'll see you in the next one.